Hello and welcome. You've worked hard for decades, and now you're starting to think about this next chapter called retirement. And one of the biggest questions that I always hear is, when should I take my Social Security and how do I make the most of it? But here's the challenge. The rules around social Security can be quite complicated, right? There are headlines that are telling us that Social Security may not even be there for us when we're ready for it. And one wrong decision could mean leaving thousands of dollars on the table. And that's why we're here today. It's not really just about Social Security, but it's about your retirement and making sure that you feel confident about the decisions and the choices you're making. Before we get started, I want to just share with you just a little bit about why this topic matters so much to me. My name is April Schoen, and I became a financial advisor because I know what it feels like to make financial decisions that matter without feeling like you have all the information. And I hear that a lot from people that are nearing retirement. You've worked hard, you've done the right things, you've saved, but now these decisions feel bigger. And you don't want to look back years from now and wish that you had done something different. That's why my goal today is to help make Social Security a little clearer, to bring some clarity so that you can understand your options and make more thoughtful decisions about your retirement. And just like any big journey, it helps to have a guide, and that's where I come in. In fact, this reminds me of a trip that I took with my boys years ago. So a few years ago, I took my boys on their very first flight. They were so excited, but they were nervous. They were nervous because this isn't something that they had ever done before. They didn't know what to expect. And then when our first flight got delayed, I knew that there was a good chance we might miss our connection in Atlanta. And by the time we did make it to Atlanta, we had 5 minutes to get to our next gate. So what did we do? We ran. Like, I grabbed their hands and we ran together through the airport, and we made it just in time. We weren't the only ones that were running to that gate. And here's what stood out to me later is that my boys were not worried at all. To them, this was like a fun adventure because they knew they had me and I knew what to do. And they probably weren't even worried about if we missed that flight. They could just enjoy it. And that's a lot like retirement planning, and especially when we think about Social Security, because it's new, it feels uncertain. There are tight deadlines, there are decisions that can be stressful. But with the right person, the right guide, you don't have to carry all that stress alone. You can move forward with confidence, knowing that you're going to get where you need to go when you need to get there. So here's what we're going to walk through together today. We're going to talk about how Social Security works. So what to consider before you claim Social Security at 62, at your full retirement age, at age 70. We're going to talk about what do you need to know about the program itself. So how do taxes work? What about if you continue to work in retirement? How are spousal benefits may impact your decision? What about survivor benefits? We're also going to talk about some issues around the program. So I hear this a lot, some worry around Social Security. So we're going to talk about it. We're going to talk about what changes could come to Social Security and how do you plan around them. And after we go through all of this, I'm going to share with you how you can schedule a call with our team if you'd like to discuss your personal options. So that's going to be so that we can start talking through your different payment scenarios and how this is going to impact you. Because today I'm going to keep this high level. We're going to go through an overview, and that call is really where we get specific down to your questions and your situation. And you're going to see how important that's going to be as we go through the conversation today. So let's first talk about how does Social Security work. So Social Security has been around since 1935, and there have been a lot of changes over the years, but the basis of how it works relatively is the same, meaning that the Social Security Trust Fund is primarily funded from the taxation of wages by the current workforce. That means the current workforce, as we pay taxes into Social Security, that is paying current beneficiaries. And you're going to see later, this is actually one of the issues around the program, because back in 1945, for example, we had about 40 workers to one beneficiary. But now Social Security estimates that by 2035, there are going to be 2 workers to every beneficiary. So you can see already how that's a problem with the system, how that just this reduction in this ratio of how many workers to beneficiaries we have, that is going to put more stress and pressure on the system. So that's when you hear about, oh, the trust fund's going to be exhausted in 2034 or 2033. It's usually in that time frame. That's what they're talking about here, is because there's not going to be enough money that's been built into the system to pay out current beneficiaries, people that are currently getting Social Security, at the same level we have today. And we're going to talk about that later. I'll talk about what may happen, some changes to the program that we might see. And then more importantly, I'm going to talk about how do you actually plan for that, right? Because that's what we want for you. I think that's what most people want, is for you to have control over this situation and to have your plan be built in such a way that while, yes, we don't want them to make changes to Social Security, but more importantly, even if they do, we want to make sure that your retirement is not impacted by that. So we're going to talk about that later. And as you're working, you're paying into the system. So you're paying FICA taxes, you're paying into Social Security, you're earning what they call credits. And essentially, if you have been working for 10 years or longer, then you've earned enough credits for both you and your spouse to qualify for both Social Security and Medicare. So to qualify, you need at least 10 years of work history for you and your spouse to qualify. And then, so how are your Social Security benefits actually calculated? It's a pretty complex formula that they use. So and I'm going to walk through this with you. And then really what you want to do is you want to look at your statement. But the government is going to look at your highest 35 years of work history. So first off, if you don't have 35 years of work history, they're going to fill in the missing years with zeros. So that's really can pull down your average. Sometimes I have clients that work a few more years to make sure that they have those 35 years of work history. And then they're going to adjust those past earnings to today's dollars by factoring in inflation. That way, what you made 20, 30 years ago is compared more fairly to your recent income. And once they have that adjusted average, this is what your Social Security benefit is based on. And again, that calculation of your benefit is pretty complex, so it's best to review the amounts on your specific statement. On your statement, you're going to see your Social Security benefit at different levels, from the earliest that you can claim at 62 all the way through age 70. Now, paper statements are no longer mailed, so it's best to create a login. If you haven't already done so, you can go to ssa.gov. You can create a login, and this is where you want to make sure that you're downloading your specific statement. They do have some calculators that you can use, but you really want to make sure that you're logged in so that they're using your record. Like on your statement, you're going to see your name, so you'll know it's directly for you. Again, you're going to see your Social Security benefit at different ages, from 62 all the way to age 70. It also includes your earnings history as well, if you want to see that, and you can see if there's any changes that need to be reflected on your earnings history. And then there's one thing I want to note here on the Social Security statement is when you're looking at your benefit record, it assumes that you're going to continue working and earning your current salary until those ages. So if you are 57 and you're looking at your statement and it's showing you what your benefit is going to be at 62, at your full retirement age, at age 70, it assumes that you're continuing to work between now and then, earning your current wages. So that's really important to note when you're looking at those statements. So let's go through and think about your Social Security benefit, what impacts that. We're going to talk about claiming it early. We're going to talk about extending to age 70 and some things to know about the program. One of the most important things to understand about Social Security is what is your full retirement age. Now, your full retirement age, or sometimes called your FRA, this is the age when you're entitled to receive 100% of your benefit. And your FRA, your full retirement age, is based on the year that you were born. So if you were born in 1960 or later, your FRA, your full retirement age, is age 67. And again, that means that you would be receiving 100% of your benefit, your full benefit, at age 67. So why does this FRA matter? Well, it really sets the benchmark for everything else. Because if you take Social Security before your full retirement age, your benefit is going to be permanently reduced. But then if you wait past your full retirement age, your benefit will grow every year that you're delaying up until age 70. And once you reach your full retirement age, you can work and earn as much as you want without any sort of penalty from the Social Security. So knowing when your full retirement age is the foundation for deciding when to claim, how much you'll get, and how working in retirement may impact you. And we're going to look at an example of if you were to do that. So now that we know that full retirement age is the point where you get 100% of your benefit, let's look at what happens if you claim earlier or later. So let's say your full retirement age is age 67. The earliest you can claim is age 62. And if you claimed at age 62, then your benefit is going to be permanently reduced to about 70% of what you would have received at your full retirement age. So let's say at your full retirement age, your monthly benefit would have been $2,000 a month. Then at 62, it's going to be closer to $1,400. And again, that is a permanent reduction. Sometimes people think, hey, I'm going to get this reduced benefit now at 62, but when I turn my full retirement age, they're going to increase my benefit. And that is not accurate. The current maximum monthly benefit for someone reaching their full retirement age currently in 2026 is $4,018. So again, if your full retirement age was 67 and your benefit was going to be $4,018, if you claimed at 62, it would be about $2,800. And then if you let your benefit continue to grow past age 67, your Social Security benefit is going to grow 8% per year. But age 70 is the longest that you would want to wait. There is no benefit in delaying Social Security past age 70. But again, from 67 to 70, your benefit is going to grow by 8% per year. Also, if you're continuing to work during that time, you're continuing to pay into Social Security, you're building up additional credits in the system, and that also can increase your benefit. So you can see how in this example of someone claiming from age 62 to their full retirement to age 70, that there's a big difference in what that monthly benefit would be to you. And that's why this decision of when to claim is so important. So on your Social Security statement, you're going to see your personal benefit amounts listed. They're going to show you from age 62 all the way to age 70. And again, they're assuming that you're continuing to work until you hit those ages at your current salary or income. Now, there is no perfect age about when to claim Social Security. The right decision depends on your health, your income needs. What about your spouse's benefits? Taxes. Are you going to be continuing to work in some capacity? What other income sources do you have in retirement? I meet clients where it makes total sense for them to start taking their benefit at age 62. Maybe they're going to have a pension and they're going to have Social Security, and then they have other investments in retirement accounts. And it may make sense at that point to go ahead and start Social Security because they need the income. So often when people ask me, April, should I take Social Security or not? One of my questions is going to be about, hey, are you going to be working in some capacity? What other sort of income sources are you going to have? But generally, by and large, if someone says, I am either going to need to take Social Security or start taking income from my retirement accounts or my investments, for example, then I may recommend they start their Social Security benefit. Why is that? I understand that benefit is going to continue to grow as you delay it, but Social Security is also not liquid. I'd rather you keep your money growing for you on your balance sheet. You can't go back to Social Security later and say, hey, I need $20,000 because I need to replace my roof. And then also starting that Social Security benefit is going to give you that foundation for your retirement income. So think about this. If you've got Social Security, if you have a pension, now you have this baseline of guaranteed income in retirement. That means it's less money that you have to pull out of your retirement accounts, out of your investment accounts. So you're putting less pressure on your other investments. So you can let those continue to grow for your future, which can help offset inflation. But that is why Social Security should not be decided in isolation. There are also situations where, let's say, for example, for a couple, we may look at both Social Securities and suggest that the higher income earner, maybe they wait until age 70 to claim their benefit. Because if they wait, their benefit is continuing to compound and grow, and that larger Social Security benefit is what is going to be left to the survivor. We're going to get into survivor benefits in a little bit. But you can see how there's situations and times when we may want to start it early. There are situations and times where we may want to delay to get a larger benefit. So again, we don't want to make that decision in isolation. This should be coordinated with the rest of your retirement income plan. So if you're already starting to think, hey, I'd like some help in looking through my options, and if you'd like to schedule a call with our team to discuss those, I'm going to drop a link in the chat box, in the description box, for you to begin that process. So you can request our financial planning intake form. This form is the first step in scheduling a call with us because this form should only take you a few minutes to complete, and it helps us just understand a little bit about, where you are, what kind of support you're looking for, and helps us determine that next best step. And then from there, when you return that back to our office, we review it and then we'll reach out to schedule your call. So again, I'm going to drop that link to request the intake form. It'll be in the chat box and the description box if you'd like to schedule a call with our office to start walking through your personal options. Now, Social Security does include a cost of living or a COLA. And for example, in 2026, the COLA was 2.8%. But the COLAs are not guaranteed every year. We've had years when the COLA was zero, like back in 2016. In 2017, it was less than 1%. So we've had years when that COLA has been very low. So even when these benefits do increase, it doesn't mean that this COLA is going to be enough to keep up with your personal inflation rate. So we think about your lifestyle, we factor in healthcare, housing, food, other rising expenses. This COLA is helpful, of course, but it is not going to complete your retirement income plan. This is why we have to have other income sources and why that plan is so important. In fact, when I am doing planning for clients, we don't even factor in a cost of living adjustment on Social Security at all. Like, I would just rather pretend it never increases. And that way, when it does, it's some icing on the cake. The other thing that we've seen happen is when there is a cost of living adjustment on Social Security, guess what else happens? Your Medicare premiums go up at the same time. Yep. So you might see, oh, great, I'm getting an increase on my Social Security, but then my Medicare premiums are going up. So it's basically a net wash. So again, in my planning, we do not anticipate a COLA on Social Security. Now, Social Security benefits can be taxable. This is going to be dependent on your overall income. So Social Security looks at something called your combined income, which includes your Social Security plus other income like pensions, withdrawals from retirement accounts, part-time work. And the higher that combined income, the more of your Social Security is going to be considered taxable income. For most people, 85% of your benefit is going to be considered taxable income. So for example, if you file your taxes married filing jointly, and you've got combined income between the two of you of over $44,000, then 85% of your benefit is going to be considered taxable income. Now, we did have an increase last year with the tax law changes to have the increase, what they call that senior bonus deduction for people who are over age 65, where you've got an increase in your standard deduction. But there are income limits on that as well. So if you make over $150,000 married filing jointly, they're going to start to reduce that additional standard deduction. So we want to plan ahead for this and just understand how taxes are going to impact our retirement plan, not just from Social Security, but thinking about the whole picture: Social Security, pensions, retirement accounts, taxable accounts. How does all of that work together? I will also mention that you can have Social Security withhold taxes. Sometimes clients don't realize that, and they run into a problem because Social Security is not withholding tax, and they might owe a lot at the end of the year. They might have penalties, but you can have Social Security withhold taxes. Now, sometimes I get asked about continuing to work and claiming Social Security. And this is when it matters about when are you going to be starting to take Social Security and how much income are you going to be making from earned income from, let's say, either full-time work or part-time work. So if you start your Social Security benefit before your full retirement age and you're still working, Social Security may reduce your benefit. So this is a deterrent. They do not want people continuing to work and claiming Social Security. They want you to wait to take your benefit. So if you're under your full retirement age, and this is for 2026, and you have wages. Now, wages would be earned income. So this does not include income from a pension. This does not include income from retirement accounts or investments or interest and dividends. This is truly earned income from either part-time work or full-time work. But if you have wages over $24,480, then Social Security is going to start to reduce your benefit basically in half. They're going to reduce it $1 for every $2 over that limit. Now, the good news is once you reach your full retirement age, those limits do go away, and they'll actually make an adjustment to your payments to account for that reduction. But it still doesn't feel good to have your benefit reduced. And for most people, if you're continuing to work, you're better off delaying taking Social Security to have that benefit continue to increase. However, once you've reached the month that you turn your full retirement age, there is no earnings limit. So like my birthday's in December. So if I was turning 67 in December and I started my benefit in December, Social Security does not care how much money I make. I can make $1 million a year and still claim Social Security. So the closer you get to that full retirement age or past, it's easier to keep working without impacting your Social Security benefit. And when in our work with clients, we run these numbers all the time to show you how working part-time, how delaying retirement might impact your benefits. And the other question would be, if you are still working and you're your full retirement age and you start collecting Social Security, what are you going to do with those checks? What are you going to do with that income? We want to be strategic and tactical. It's not something you want to have that income come in and then good uses of those dollars would be to like build up additional assets on your balance sheet, pay down debt, for example. If you're going to claim it and you're still working, it should be for a very strategic reason. Otherwise, delaying and getting those increased credits is probably going to be more beneficial for you. So now let's go through and talk about some different payment scenarios. The first I want to talk about is spousal benefits and how they work. So when you qualify for Social Security, your spouse qualifies too, even if they did not work as many years, even if they didn't have as high of income. So the Social Security Administration is first going to look at your spouse's own benefit based on their salary history. So Social Security has something called deeming rules. They're deemed to pay you the highest amount. But if that amount is less than 50% of your benefit, Social Security will increase your spouse's benefit so they receive an amount equal to half of yours. So in short, your spouse always gets the higher of the two options, either their benefit on their own record or half of yours. So let's say your Social Security benefit was $3,000 a month. Your spouse is either going to receive their benefit or half of yours, which will be $1,500. They're going to receive whichever is higher. And a lot of people are actually not aware of spousal benefits. I have clients where maybe the spouse did not work much out of the home. Maybe they don't even have those 10 years of work history to qualify, and they don't realize that they're also entitled to that spousal benefit. So in retirement, I actually was just going through this with a client a few weeks ago. He's 57. He's probably going to work several more years, but we were looking at what his Social Security benefit was going to be at 65. And then also assuming then his spouse, she's going to get her spousal benefit, which would be half of his. So really important to know about the spousal benefits and how they work. There are also survivor benefits for widows and widowers. And the simplest way to think about this is that when one spouse passes away, the smaller Social Security check typically goes away and you're going to receive the larger of the two. So let's say you have one spouse was receiving $3,000 per month and the other spouse was receiving $1,500 per month, and one of them passes away. The surviving spouse is not going to receive both checks. They're going to get to keep the larger of the two, in this example, $3,000 a month. And sometimes we're not aware of that either. And we don't plan for that of like, hey, what happens when one of us passes away? We're going to lose this Social Security benefit. And we need to have a way to replace that income. So how do we replace it? It could be from retirement accounts, investment accounts. It could be life insurance. There are ways that we can set aside assets to be able to replace that Social Security benefit when one of you passes away. And that's why Social Security claiming strategies, it's not just about your income. For married couples, this decision impacts both of you. And so there can be these, so we have to make sure that we're planning for that for you and for your spouse. One other thing I want to point out here is there could be some additional claiming strategies for widows or widowers if you haven't started your benefit yet. So let me give you an example. I had this happen a couple years ago. One of my clients was collecting Social Security. Let's call him Jim. So Jim was collecting Social Security. His wife, Sally, was not taking hers at that time. Jim passes away. So what Sally at that time did was she actually just started getting her survivor benefit, which was equal to what he was getting. And she let her own benefit grow until age 70. And then at age 70, Social Security automatically switched her from getting the survivor benefit to getting now her benefit on her own record, which was much higher at age 70. So if that's you, that impacts you, jot that down. That's something we can talk about and look at, but that is a claiming strategy for specifically for widows and widowers if you haven't started your benefit yet. There are also spousal benefits for divorced spouses. So if you were married for 10 years or longer and you're currently not married, you will be eligible for benefits on your ex-spouse's record as early as age 62. And this works just like the spousal benefit. If your own record, your own benefit is less than half of your ex-spouse's, then you're going to receive an amount equal to half of their benefit. And your spousal benefit for divorced spouses, it does not impact or affect the other spouse at all. So it doesn't matter if your ex-husband, your ex-wife, it doesn't matter if they've started their benefit or not. It doesn't matter if they've remarried. You still have this benefit available to you as long as you were married for 10 years or longer. So this can be a very important planning strategy in your overall retirement plan if that is something that impacts you. Now, let's switch gears a little bit and talk about some issues around the program and then some things for you to be thinking about and planning. So, one of the risks that we see with Social Security is, again, this idea of fewer workers to beneficiaries. So, if you go to the Social Security's website and you read their latest trustees report, they are projecting that the trust fund will be depleted in 2034, which is not that far away. And under current assumptions, at this point, they'll only be able to pay out 81% of scheduled benefits. So what does that mean? That means if no changes are made and we get to 2034 and this comes true, if you were receiving $1,000 a month, you're now getting $810 a month. And so one of the reasons this is happening is because of this worker to beneficiary ratio. Currently, well, actually, this was as of 2023, so this is a little bit old. 2023, there was about 2.7 workers for each beneficiary. You can think about what I was showing earlier about maximum benefit amounts or average benefit amounts, and you think about having 2 to 3 workers have to pay enough taxes for that one beneficiary. You can see how that really starts to put stress and pressure on the system. But yes, if we go back and we look, like historically, like in 1945, there were 41 workers per beneficiary. So this shift is definitely causing stress on the system. And I talk about these projections, it's not to scare you, but it's to emphasize why having a personal retirement plan is so critical. Now, I believe that Congress, the government, will make changes between 2034, and I believe there will not be a reduction in benefits. That's my personal belief. Now, I also believe they are going to make changes to Social Security. I'm 42, so I think I'll see changes to Social Security. Specifically for me, I think maybe they're going to increase those ages of when you can claim. Maybe even, what's the earliest you can claim? What's your full retirement age? That's not going to be their first, I think the first thing that they'll do. They could also increase how much we're paying for the taxes, how much income is actually taxed for Social Security. So there are some different things they can do to solve that problem. I think if you're close and you're in that probably like that 10 years or less from taking Social Security, in my personal opinion, I don't think that you're going to see any changes to your benefit. I do believe that they will act to make sure this doesn't happen. However, with that being said, I also believe it is so critical that you have your own personal retirement plan where it does not matter if Social Security gets reduced by 20% or not. How about we have a plan where we plan for that? And if it comes true and comes to fruition, that we're not worried about it, that we know exactly what's going to happen. We know exactly what we're going to do if that were to happen. Because what I want is for you to have more control and not be left to the control of somebody else. We want you to be able to control your personal economic plan, not be reliant on the system, right? So that's what we want to work towards. And one of the most important things I think to also think about Social Security is that it was never meant to be your only source of income in retirement. It's meant to be a foundation. And this information here comes directly from Social Security's own data, and it shows how much of your pre-retirement income Social Security may replace depending on your earnings history. So they look at what they call are like high earners, which is someone making around $100,000 per year in pre-retirement. And they estimate that Social Security is only going to replace 25 to 30% of that income. And that is a key planning point. So if Social Security is only replacing part of your income, then that rest has to come from somewhere else. It has to come from a pension, retirement account, savings, investments, maybe continuing some part-time work. And that's why retirement planning is not just about deciding when to claim Social Security. It's about understanding how Social Security fits in with everything else you've built and how all those income sources are going to work together to support your lifestyle. So at this point, if you, are thinking, yes, this is really important. Social Security is important. It's too important to leave just to guesswork. And this decision about when to claim Social Security should fit in, again, to your larger retirement income plan, thinking about all those other things in your financial world, your pension, retirement accounts, your spouse, savings, taxes. And so if you'd like to start thinking about, hey, how does this impact me? And if you'd like to schedule a call with our team to walk through your options, then the first step to do that is to request our financial planning intake form. We've added the link. It's in the chat box or the description box. You can also scan the QR code on the screen. You're going to request the intake form. Once you fill that out, it just takes a few minutes for you to complete it. You email it back to our office. We will review it, and then we're going to reach out about scheduling your call. Again, so important so that you can look at those options. And as we wrap up, this is why I do this work, because retirement planning is not just about numbers. It's about helping you avoid regret. It's about protecting the life that you've worked so hard to build and make decisions that you can feel good about now, plus in years to come. And yes, Social Security is one of those decisions, and it should not be made in isolation or left to guesswork. So my hope today is that this did give you some more clarity. It helped you see some of the questions that are worth asking before you claim your benefit. So I just want to say, thank you for joining me today. I hoped this helped you have some better understanding and clarity around Social Security. And I look forward to connecting with you all soon. Bye now.